Welcome to the Lighthouse Financial Advisors Money Over 50 podcast with Dallas Davison and Michael Hogue. This information is general in nature and does not take into account your objectives, financial situation or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Lighthouse Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50 with Dallas and Michael. The weekly wrap-up today being Saturday morning. And the headline today, Dallas, 24% off everything.
24, is it? Yeah, I was wondering that.
24% off everything.
Yeah.
We don't know a lot, but we know one thing for sure, is that the theory that I announced back on the 24th of April has come true, and the markets of the world agree with my theory.
Jesus. This is this theory. It's the least well thought out theory I've ever heard of from you, Michael. I expected better, but anyway.
So a short recap on the 24th of April, when we were 27% down, and the week before we were 23% down, the week before that 25% down. I said that I believe that the markets are scared not of dropping further, but they're scared that this will recover quicker, and that
it will get.
The fear wasn't from a further drop. The fear was that things would recover faster, and that's why they hadn't dropped as far. Given that it wouldn't have been unusual to expect somewhere in the vicinity of a 40% drop based on the economic data coming out and the news. So we're at 24% down now. If we go back exactly 1 month ago, the 9th of April this year, we're recording, of course, on the 9th of May, 25% down, 23% down, 27% down, 27% down this week, 24% down. So we're basically in the same position that we were in April 1 month ago. So if we look at America, they've improved. Well, we've improved 3% this week, so we were down 27% last week. We've improved to 24% down. America, or the S&P 500, the largest 500 companies in America, have actually improved from 16% down to 13% down. So again, I think I still maintain that the markets, and when we say the markets, we're talking about all the participants that are looking to either holding companies or shares, or they're looking to buy companies or shares, or they own them through the super fund or whatever. All of those participants have actually decided that the price right now, it's not to say that it won't drop away further, of course, but they've decided right now that the price should only be down somewhere in the mid 20% range in Australia, and remarkably in America, the price should only be down only 13%. Now, bearing in mind what's relevant about a 13% price drop is that the average in any given year, the average drop that you see in Australian companies' share prices and also American companies' share prices, somewhere in the vicinity of 14%. So on any given year, you'll see the average price pull back by 14% for no apparent reason. And then actually recover. So they're only in that range right now.
Yeah, and it's an interesting one, especially like you say, in light of, and this is what we were talking about last weekend. It's so easy to get the two conflated. The economy and the share, if we talk about the share market being the average price of companies, which we always sort of talk about. But you look at, and I was talking to a mate about this, same mate, Mullet. He said thanks for the shout out last weekend, so I'll give him another one today. But we were talking about how the economy and the share market are not the same thing, and a guy that he'd listened to actually put this in a much better way than me, so I'm going to steal it, which is effectively that, and I'll sort of add a bit to it, is that the price of a company's share price is a reflection of a prediction of their future profits, the future cash flows. So there's sort of three separate things here, which is the share price reflects, like you said, what all participants, all the people who are buying and selling shares in that company, it reflects what they think the profits of that over the lifetime of that company will be, and what their share of those profits will be. The headlines that you're reading in the newspaper or wherever every day, that's a reflection of what is happening right now. And the economic data that you read about of this many unemployment claims, of this much GDP contraction, that's all historical data, even if it's only over the last week or month or however. So that's kind of why, when he said that, sort of got that straight in my head a bit as to what the point I was trying to make there, which is that when we're talking about how the economy and the share market are not linked, are not correlated in that one-to-one way that you'd think they would, it sort of makes sense. Because if you look at the price right now versus the price a month ago, all of that data was already priced in a month ago. So there's really been, there's been no change, I would say, compared to what most people, I guess, predicted what would happen. We knew a month ago that things in America were going to get pretty bad because they hadn't taken steps to stop coronavirus early on. We kind of knew that. We're not supposed to knew, but that was a pretty good prediction a month ago. And so, even though that has, if you looked at coronavirus numbers in America, the effects on their economy, their unemployment numbers, all those sorts of things, that was already priced in a month ago. So everything that we've seen play out over this last month, it's just all the stuff that was already predicted in advance. And so that's kind of the point that you're making now, is that the price point that we're at here is really just a reflection of all of those participants that are buying and selling those shares. It's a reflection of what they think will happen in the future over the lifetime of that company and what profits are likely to be. So it's kind of one of those things where we end up, we sort of talk around this about, and the end result is, unless you think you know more than the average of these people who are doing this for a job and trying to work out what these profits will be, it's very hard to go, well, the price is down 13% in America and 4% here in Australia. I think the price should be different. You're starting to get in a very hairy territory where you're trying to be smarter than everyone else and trying to predict not just what you think will happen over the next month, but what you think will happen over the next month, what you think other people think will happen over the next month, and then where we'll end up. It's just like I keep saying, it's just not a game I want to play. Like and that's why we say we've got no idea where things will be in a month. And we know that even if we could predict where things will be in a month, we don't know what effect that will have on share prices over the next month either.
And we don't want to give the wrong message. I mean, we raise this only in the context of people that had panicked or were thinking of panicking. And I mean, this whole weekly wrap up podcast was born out of I guess. The pressure for a lot of people to change the investment strategy of their superannuation funds, the social pressure or the peer pressure in terms of people's friends saying, hey, all right, you haven't sold out and moved to cash. You haven't. So most of that happened. And we know we know that the most amount of people panic at the worst possible time. And that's precisely why it is the worst possible time. So back on the 23rd of March this year, the Australian market was down 36% and the American market was down about the same. We know that a lot of people changed their superannuation fund strategy and moved to cash. So they sold out at actually 64 cents in the dollar for both their Australian companies and their US companies that they own within their superannuation fund. They're looking now at the Australian companies being valued at 76 cents. So they sold out at 64 cents. And the Australian companies are now valued at 76 cents. So if they move back in now, they're moving in at a 12 cent higher price. With the American companies that they sold out, they've grown to 87 cents. So they sold out at 64 cents. And they've grown now to 87 cents. So I mean, we've always maintained that it's a mug's game to try and sell out, to try and predict what's going to happen in the future. And certainly, I always put that into perspective in terms of we may not have seen the bottoms yet. The market may very well turn around and move back. However, I'm actually guessing that a lot of these people that sold out at 36% down they've either moved back in now at higher prices, or they are suffering such anxiety now, seeing what these prices have done, and wondering if they'll continue to grow, wondering if they should move back in at this point in time and actually crystallise that loss.
And I think that's, so to use your price analogy there, I always like to bring that back to, so for most people, they can really imagine the cost of a house. So if you're 60 now, and this is obviously we're talking about retirement planning, some of your assets that you own coming into retirement, you will need to own for 30 years. You will need to be selling that down in 30 years time to fund your your later years of retirement. It's no different to if you own a house at age 60 and you plan on living in that until you die. So you might say, well, I need to own this house for 30 years. Now, if that house is worth $1 million and it dropped, and it was as liquid of an asset as your investment strategy of your super fund, your $1 million house dropped to 640,000. Imagine if you had sold your house at that point in time. So you move that money, you've got that $640,000 in your bank account. And your theory there at the time was probably, I'll take that $640,000 cash. When things drop further, which I think they're going to, I'll buy my house back at a cheaper price. And that's sort of the game you're playing. Now, imagine that $640,000 sitting in your bank account, but house prices have jumped back up. And so that same house that you just sold is now worth $760,000. So really, like you say, imagine the anxiety of trying to go, well, I want the same amount of house. I need the same amount of house, but now how do I fund that shortfall between what I did own previously and now what I've got in cash isn't going to buy me what I had before.
And here's the equation, Dallas, and we know that most people sell out at the bottom of the market, and that's why it is the bottom. I mean, the price is reflective of so many people selling at that particular point in time that it pushes the price down, and it finds the bottom. So you've sold out at 64 cents, like you just said, or you sold $1 million house for $640,000. You're now seeing that house has risen to $760,000, or if we're talking about your superannuation, it's gone from 64 cents where you sold out to 76 cents or 87 cents. I can tell you where the level of anxiety comes from and why most people actually buy back in at $1 in the dollar or higher. Is everyone's waiting for that second drop to happen now. And part of being an optimist, you have to tell yourself, well, I shouldn't say that. Part of probably not admitting to yourself that you made the wrong decision by selling out at 64 cents when the price has risen to 76 cents is that you need to, if you actually move back in at 76 cents, you've actually admitted to yourself that you've made the wrong decision.
It's funny.
Whereas you're waiting for the second drop to happen. Now,
you can say
will or will not happen. It will or will not happen. And what actually happens for most people we know is that the price, things settle down, which means the price has returned to $1. And it's grown to $1.10. And some of these people are still waiting for that drop to happen at that point in time. And then, it doesn't happen and it moves to $1.20. So for a lot of people, we've compared we've compared selling out at 64 cents and buying back in $1. A lot of people won't buy back in until $1.20 or $1.28. So they will have halved the value of because they're actually waiting for that second drop, which may or may never happen.
I mean, it will definitely happen. It's just a matter of whether will that drop be from $1.30 to $1, or will it be from 70 cents to 60 cents?
Yes,
we know there's going to be a drop in the future, but the risk is that while you're waiting for that drop, prices pick up so that even after that next drop happens, it could still be above where you're sitting now in cash.
That's right.
This segues it's like we've planned. This segues very neatly into my thing that I was sort of thinking about this week that I wanted to discuss, which is that so much of financial planning and so much of our people's dealings with money is around the story that we tell ourselves, or the story that we have in our head as to what's happening, and that's a really good example of one where if you've sold out at 64 cents on the dollar, there's, as you say, there's two options here. The completely, and the reality is we're human beings. We are going to have, there is some narrative that we're telling ourselves. So if you are telling yourself, well, I'm waiting for the price to drop to 50 cents and then I'm going to get back in, and then all you suckers will, then you'll all be hurting and I'll be better off than all of you are. That feels better in the short term because like you say, you don't have to then admit to yourself, geez, maybe I made a mistake here. Maybe I sold out at the wrong time. You can tell yourself that it's okay. I'm just waiting to be proven right. I'm not wrong. I'm just not right yet, kind of thing. So, but I find that a lot of, and I don't know, it's probably similar for yourself, but with clients, a lot of what I talk about is not so much about changing what you're doing. It's just changing the story that you're telling yourself. And that's why we named these weekly updates, however many percent off for the week, because it's, as soon as you change that story to, I'm accumulating these assets for my retirement at a discounted price, it makes it then a more pleasant experience. To every week, if you're going to work, your employer's putting money into your super fund, you're putting money into your super fund. If the price has dropped, all that allows you to do is buy in at a cheaper price that week. And that's kind of the thing, that the narrative of, if we tell ourselves that I just want my super balance to grow and never go backwards and just keep going up and up and up, it's not really logical when you think about the fact that you're still accumulating. If you're still working, you're still contributing into super, you actually want prices to stay down while you're still buying in. Does that make sense?
Look, absolutely. And like, I find it interesting. I like the way that you frame that, actually, because, if you tell yourself, okay, I'm worried about a drop. I forget exactly how you led into that, but if if that's the story where you're worried about the drop and you've sold out at 64 cents and you're waiting for it to drop to another 50 cents, that's what you focus on, versus someone else who is just accepting that markets are volatile and prices are volatile of everything around us. And it's not just the great companies of Australia and the world, it's everything around us. Yeah. I won't say that bananas will fluctuate in price.
I was waiting for the banana story to come.
You hate me talking about bananas fluctuating.
I've just heard it so many times, but
I won't say that. But yeah, if you're focusing now on, okay, well, the $1,000 a fortnight that I'm putting in as I approach my retirement, every single fortnight that I get paid, I put $1,000 in. I was buying 1,000 shares at $1 a share. I'm now buying so many more shares. At 76 cents a share. So it's a completely different way to look at things. Yeah, and look, we would say it's a much better way to look at things, of course.
Well, the thing about it, it's like anything where you can. There are many things in our life that are out of our control. So, and this is one of them, I think. Like, movements of, that's why I never understand the conspiracy theory of some conspiracy about moving the share market, where there's trillions of dollars moving around in different assets that are buying and selling, and that's what's setting the price. There's no one person that's responsible for what NAB shares are next week. It's just an accumulation of all those different actions and people buying and selling and what sets the price. So you can't control that. There's no way to control that. Even if you wanted to, you couldn't control it. So really the only thing that you can control is how you think about that and as a result, how you feel about that price movement. So that's the big thing is to me, it's sort of about getting that story and having that plan. And obviously it all comes back to going, what is my long-term plan here? What is it that I'm trying to achieve? How does this volatility each week, how does that actually help me to achieve my goals? And what's the positive spin on this that I can put? Yeah. Obviously, you don't want to bury your head in the sand and say, oh, well, everything's all rosy and it's all only positive. You have to be realistic about it, but there is always good and bad in everything. And I think that's, to me, a big thing about what we try and do with our clients is to diagnose what is the story that they're telling themselves, and is that true and is that useful to them? And so it's really about going, you need to make sure that story is both realistic and it's true and it's actually what's happening. But then you also need to make sure that story is something that helping them sleep at night and helping them process what's happening in that day-to-day life without just stressing about money the whole time.
Yeah, and I mean, since we became business partners, you've taught me a lot about psychology. So I will say that you've helped me. You've added something to me there.
Is this your acceptance that I'm the number one financial planner in Australia? Is this the time when you come to?
well, like I said, it's been tiring for all these years. So I'm happy, grasshopper, if you take over as. I mean, I never appreciated the psychology of it. So there is so much psychology with everything that we do, and certainly, I think to frame it where you're looking at an opportunity where the markets drop, and it's not like you're going to be clicking your heels, jumping for joy, and you're putting in at the bottom and all of that sort of stuff with a big amount of money. What it is just, I guess, looking at the glass being half full and saying, okay, we're suffering this volatility right now. Hey, this is the last 10 years of my working life, for example. And now more than ever, I've got the most disposable income I've ever had because the kids have finally graduated university and the mortgage is paid off. And we're earning our peak earnings capacity right now, even though that may have been paused for a little bit with depending on who you work for or what industry you are in right now. So the glass is half full. I'm really accelerating my retirement planning here by putting in as much as I can every fortnight. And the gift horse here is that I'm actually buying in 1,200, 1,300 shares every fortnight when I would have actually only been buying in 1,000.
Yeah, that's right. And I mean, again, to bring it back to concrete terms, that people, like I keep going back to the house example because that's how, I think that's the biggest asset that people purchase that they can sort of visualize is that if you said, when I retire, I need 7 fully paid off investment properties. That's what I'm going to live off now. Number one, I'd say it's a terrible idea, and we've got a whole podcast about why you wouldn't want that. But if that's what you decided you needed was 7 investment properties, if you've only bought 3 or 4, you really don't want the price to go up at all because you still need to buy those next 3 houses, and you hopefully want to buy them at a cheaper price. So that's the same way to think about investing in companies through your superannuation fund is that you really don't want the price to go up until you've finished accumulating.
Absolutely. Even taking it back to, say, you're building a house and the normal phase of construction is that the house obviously gets built piece by piece. So, the first bedroom that you built cost you $50,000. By the time, and then they build the rest of the house and the house prices are falling. And by the time they built the 5th bedroom in that house, because of the price of everything, it drops. That bedroom only cost you $35,000 instead of $50,000. You would be jumping for joy. You'd be going, this is so fantastic. The first bedroom that we built at the start of this construction phase cost me $50,000. I'm building the same thing here. I'm picking it up for $35,000. So in that analogy, you'd be so happy. So it's certainly no different in terms of and I guess what helps you with the house example, because everyone listening would of course no doubt agree that would be a good thing. Now I think implied in that is number one, I can see this house. I know that it's worth something because I can see it going up before my eyes. And number two, it's implied also that it's a long-term asset, isn't it? And you mentioned you started way back at the start of the podcast saying it's a 30-year asset, and but a big portion of your superannuation and the companies that you own in your superannuation fund are also a 30-year asset as well, because you don't sell the day that you retire. You don't sell all of your shares or all of your companies and then put them into the bank account. You're carrying forward some of those for 30 years. So people could quite easily get that analogy and say, I would love the price while I'm building a house to be going down. Now, what they're not thinking is that, damn it, I paid $50,000 for that first bedroom and it's only worth $35,000 now.
That's
what
right.
they're thinking is, I'm so happy that
Yeah,
I got the fourth bedroom
Yeah.
for $35,000.
Yep.
Because
Yeah.
it's taken 12 months to build this house, and then built the first bedroom first, and then the fifth bedroom, and they built the fifth bedroom right at the end.
Yeah.
So you're not thinking that you've done money on the first bedroom.
No,
So,
you're just thinking about how cheap it is that you're buying in now. Yeah.
Whereas I think for a lot of people right now, they're framing they're framing this completely wrong, and they're saying it's the money that I've put in the past. Gee, that's only worth 64 cents. I'm going to panic now. I'm going to sell that and move that to cash.
Yeah.
They're not thinking about it's the fortnightly money that they're putting into the superannuation fund that they can take advantage of.
Yeah, no, exactly right. And that's, I guess, the thing that the point I want to make is that so much of that is just changing that story. It's, the two people can be doing exactly the same thing. They can have $500,000 in their super balance, and they can be contributing $1,000 a week into superannuation between them as a couple. So they might both be doing the same thing. If one of them has that story right in their head and they are thinking about how cheap they're buying in right now, they're going to be going to work every day really happy about the opportunity to buy at this lower price. Whereas the other people that are looking at their balance day to day and worrying about what the price of those assets they've already accumulated, they both have to go to work. They both have to do the same thing. They're both still doing all the same thing. It's just that one of them's having a much better time than the other. And it's just down to that story.
You have anything to add, Dallas?
No, I think that's pretty good.
It's a pretty good place to wrap up. I can hear your boy Winston.
Winston is
starting to crack up in the background.
Just start banging on the door soon and want to come and get involved. So,
good place to wrap up. Go and be a dad.
Yeah, very good.
Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Lighthouse Financial Advisors. We look forward to catching up again soon.